What is happening, crypto crew? Welcome back to Bitcoin Bulletin, where we break down the moves that matter in the fast-paced world of digital assets. The markets are buzzing, and the news cycle is spinning faster than ever. Today, we've got a massive story about a dormant giant waking up. An address holding a significant amount of Bitcoin, untouched for over a decade, has suddenly sprung to life, moving millions. What does this mean for the market? We're diving deep. But that's not all. We're also exploring the strategic necessity of Bitcoin in institutional portfolios. Why are the biggest money managers shifting their focus? And what does this mean for the future of asset allocation? This is crucial context you need to understand the bigger picture. And in a move that's sending ripples across the industry, we're breaking down BlackRock's significant transition from Ethereum to Bitcoin. What's behind this massive reallocation, and what are the implications for both of these major cryptocurrencies? This is a game changer. Finally, we're looking at the current market sentiment as Bitcoin, Ethereum, and other major coins slide. Are traders bracing for a drop to $100,000, and what are the key levels to watch? We've got the analysis you need to navigate these choppy waters. Stick around, your next big insight is just minutes away. Make sure you're subscribed and the notification bell is on so you never miss a beat. A sleeping giant awakens. Bitcoin whale moves $52 million after 13 years. An incredibly long dormant Bitcoin address, holding over $52 million worth of BTC, has suddenly become active after more than a decade. This isn't just any transaction. It's a significant event that has the crypto community buzzing with speculation about its potential market impact. The address, which had been a silent holder since 2012, received small amounts of Bitcoin over the years, accumulating a substantial stash. Now, a portion of that hoard, over 80 Bitcoin, valued at approximately $8.88 million, has been moved to new active addresses. This awakening follows a series of similar movements from other large Bitcoin holders, often referred to as whales, in recent months. These whales, entities holding significant amounts of Bitcoin, have been making waves. Some have been observed exchanging their Bitcoin for Ethereum, while others have simply begun liquidating their positions. For instance, on August 29th, a major holder deposited over 2,000 Bitcoin, worth more than $216 million, onto the hyperliquid exchange and proceeded to systematically sell it for Ethereum. Earlier in the month, another whale moved around 670 Bitcoin, valued at $75 million, splitting it across 4 wallets to initiate leveraged long positions on Ethereum. In another remarkable event, a whale moved a staggering 3,000 Bitcoin, exceeding $349 million, after holding it for a decade. Even more dramatically, in July, a mysterious whale moved 80,000 Bitcoin after a 14-year hodl, a transaction reportedly executed by Galaxy Digital on behalf of a client, described as one of the largest notional Bitcoin transactions in crypto history. It's important to note that whales aren't always individual investors. They can also represent companies that were early participants in cryptocurrency mining. When these large holders become active, it often signals potential selling pressure as the market anticipates them cashing in. However, some analysts suggest that this selling pressure from big holders has, paradoxically, helped to prevent massive price fluctuations by absorbing market movements. Currently, Bitcoin is trading below $110,000, having seen a dip of over 2% in the past 24 hours. It's down nearly 12% from its all-time high of $124,128 reached last month, and has largely remained between $110,000 and $120,000 for the past 2 months. Prediction markets show a strong sentiment leaning towards a price decrease, with nearly 70% of respondents expecting Bitcoin to fall to $105,000 rather than surpass its previous all-time high. This sudden activity from a decade-old wallet is undeniably a major talking point, sparking discussions about potential market shifts and whether this signals a broader trend of long-term holders reevaluating their positions. But what does this whale activity mean for the broader institutional landscape? We'll explore the strategic necessity of Bitcoin in institutional portfolios next. The institutional imperative: why Bitcoin is becoming a strategic necessity. In today's rapidly evolving financial markets, the role of digital assets, particularly Bitcoin, is no longer a fringe consideration, but a strategic imperative for institutional portfolios. As the digital asset class matures, a growing number of financial institutions are recognizing Bitcoin's unique properties, its scarcity, decentralization, and potential as a store of value, making it an increasingly attractive component of diversified investment strategies. This shift is driven by several key factors. Firstly, the increasing regulatory clarity surrounding cryptocurrencies is reducing perceived risks and paving the way for greater institutional adoption. As regulatory frameworks become more defined, institutions feel more confident allocating capital to this nascent asset class. Secondly, the performance of Bitcoin, especially during periods of economic uncertainty or inflationary pressure, has demonstrated its potential as a hedge against traditional market volatility. Its uncorrelated movement with traditional assets like stocks and bonds makes it a valuable tool for diversification, potentially enhancing risk-adjusted returns. Furthermore, the development of robust infrastructure, including regulated custody solutions and institutional-grade trading platforms, has significantly lowered the barriers to entry for large financial players. The advent of Bitcoin exchange-traded funds, ETFs, in major markets has been a watershed moment, providing a familiar and accessible vehicle for institutions to gain exposure to Bitcoin without the complexities of direct ownership. This accessibility has unlocked significant capital flows, validating Bitcoin's place in the mainstream investment world. The narrative of Bitcoin as digital gold is gaining traction, positioning it as a modern-day equivalent to precious metals, capable of preserving wealth over the long term. Institutions are increasingly viewing it not just as a speculative asset, but as a fundamental component of a forward-looking portfolio. The strategic necessity also stems from client demand. As retail investors increasingly engage with cryptocurrencies, institutional asset managers are feeling pressure to offer exposure to these assets to meet client needs and remain competitive. This demand fuels further adoption and reinforces Bitcoin's legitimacy. Moreover, the technological advancements and the growing ecosystem around Bitcoin, including its Lightning Network for faster transactions, suggest a dynamic and evolving future, appealing to institutions looking for growth and innovation. The strategic integration of Bitcoin into institutional portfolios is not merely about chasing returns. It's about adapting to a changing financial landscape, diversifying risk, and capturing the potential of a new, transformative asset class. It signifies a fundamental reevaluation of asset allocation principles in the 21st century, where digital assets are increasingly seen as an indispensable part of a well-rounded investment strategy. This growing institutional embrace is reshaping market dynamics and solidifying Bitcoin's role as a core asset rather than a niche play. Speaking of major shifts, a titan of asset management is making waves with a significant pivot. We're diving into BlackRock's move from Ethereum to Bitcoin next. BlackRock's bold pivot from Ethereum to Bitcoin shifts institutional sands. In a move that has sent significant tremors through the cryptocurrency ecosystem, BlackRock, the world's largest asset manager, has executed a substantial reallocation, divesting $151 million from Ethereum, ETH, and acquiring $290 million in Bitcoin, BTC. This strategic shift, meticulously tracked by on-chain data from Arkham Intelligence, signals a profound change in institutional sentiment and highlights a clear preference for Bitcoin in the current market environment. The implications of this transition are far-reaching. By favoring Bitcoin, BlackRock is not only reinforcing its position of Bitcoin as digital gold, but is also actively presenting it as a stable and legitimate asset class to a broader spectrum of institutional investors. This endorsement carries immense weight and could lead to increased volatility for Ethereum while simultaneously boosting Bitcoin's appeal among sophisticated financial players. The impact on fintech startups and their treasury management strategies is particularly noteworthy. BlackRock's iShares Bitcoin Trust, IBIT, ETF has already attracted over $21 billion in inflows, a testament to the substantial institutional appetite for Bitcoin. This mainstream acceptance provides a powerful validation for startups considering incorporating Bitcoin into their treasury diversification and risk management frameworks. It lends credibility and encourages a more proactive approach to digital asset integration. For these startups, leveraging Bitcoin's credibility can streamline treasury operations and offer access to a regulated, liquid investment avenue. BlackRock's suggestion of a modest 1–2% allocation in diversified portfolios offers a practical guideline for startups aiming to balance innovation with prudent financial management. As more companies explore crypto payroll integration, BlackRock's strategic pivot offers a valuable template. Companies can consider hybrid payment models, combining fiat with optional crypto segments, or utilizing stablecoins for salary payments to mitigate volatility. Partnering with over-the-counter (OTC) desks can provide institutional-grade liquidity and hedging tools, while robust employee education initiatives are crucial for fostering confidence in crypto compensation. Adhering to evolving regulatory compliance is paramount to avoid legal and tax complications. Managing crypto salary volatility can be achieved through diversification, implementing volatility management mechanisms like stop-loss orders or automatic conversions, and starting with pilot programs. For global operations, crypto salaries can reduce currency conversion costs and expedite payments. BlackRock's strategic shift raises pertinent questions about Ethereum's future role in institutional portfolios. As capital reallocates, Ethereum might face challenges in maintaining its preferred status. However, Ethereum's inherent utility, its robust blockchain infrastructure, and the potential for staking yields could still attract institutional interest. With increasing regulatory clarity and ongoing infrastructure development, Ethereum may regain traction. The potential for deflationary dynamics and yield generation post-merge further enhances its attractiveness as a scalable, income-generating asset. Ultimately, BlackRock's move is more than just a portfolio adjustment. It's a powerful signal shaping the cryptocurrency landscape and influencing how businesses approach treasury management and payroll in the digital age. This significant capital movement by a global financial giant underscores a clear institutional preference, potentially reshaping the competitive dynamic between the top two cryptocurrencies. But is the market reacting to these big moves? We're seeing some major price action across the board. Stay with us as we break down the latest on Bitcoin, Ethereum, and more. Market downturn. Bitcoin, Ethereum, XRP, Dogecoin slide amidst $100,000 fears. Cryptocurrency markets experienced a notable downturn on Thursday, with Bitcoin struggling to maintain its position above the $110,000 mark. This broad-based decline saw major digital assets, including Ethereum, XRP, and Dogecoin, trading lower, as traders increasingly voice concerns about a potential drop to the significant psychological level of $100,000. The prevailing sentiment appears to be one of caution, with many market participants anticipating further downside pressure. Several prominent crypto traders have weighed in on the current market dynamics, offering insights into potential price movements and strategic approaches. Michael Van de Poppe, a well-known crypto trader, identified two key Bitcoin setups: a compelling long entry opportunity in the $102,000–$104,000 zone, and a potential long trigger if Bitcoin breaks decisively above $112,000. He emphasized that price action within the range between these levels is less critical than these key support and resistance points. Meanwhile, CryptoSeth observed that significant short liquidations are already occurring in the Bitcoin market. However, he noted that retail traders are continuing to initiate fresh short positions, a behavior he warns could set the stage for a massive, biblical short squeeze, which typically involves a rapid and dramatic price increase as short sellers are forced to cover their positions. Crypto God John expressed a bearish outlook, suggesting that the anticipated downside scenario is indeed unfolding. He predicts that if Bitcoin falls below $100,000, it is most likely to occur within the coming week. His strategy involves waiting for this breakdown to complete before initiating significant long positions in the latter half of September and into October. Another trader, Dom, also known as TradingView, indicated that a break below approximately $108,000 would represent the first substantial step back in the current cycle. He utilized a staircase analogy to explain that in an uptrend, prices typically advance without significant retracing. Therefore, a move below this $108,000 level would signal a genuine retracement rather than a continuation of the upward momentum. These analyses highlight a market at a critical juncture, with traders closely monitoring key price levels and preparing for various potential outcomes, from a sharp downturn to a short squeeze. The uncertainty surrounding the short-term direction is palpable, with many investors adopting a wait-and-see approach or strategically positioning themselves for a potential retest of lower price levels. This slide across major cryptocurrencies, coupled with expert analysis predicting further drops, has created a palpable sense of caution in the market. These price movements and market sentiments are crucial to understand as we wrap up today's crucial updates. But before you go, don't miss our rapid-fire recap and our call to action. And that's a wrap on today's Bitcoin Bulletin. We saw a massive Bitcoin whale awaken after 13 years, signaling potential market shifts. Institutions are increasingly prioritizing Bitcoin, with BlackRock making a significant pivot from Ethereum, showcasing its strategic necessity. Meanwhile, the market is seeing a downturn, with key cryptocurrencies sliding and traders bracing for potential drops to $100,000. Don't miss out on these critical insights. Hit that like button if you found this valuable, subscribe to Bitcoin Bulletin for your daily dose of crypto news, and ring that notification bell so you're always the first to know. Share your thoughts in the comments below and follow us on all social media platforms for real-time updates. We'll see you tomorrow.